Hello, everybody. Happy Thursday, and welcome back to another episode of GovConHacks podcast. I'm your host, if you're new here, Ashley Duell, my co-host, Natasha Velez, and super excited to welcome Matt Stavish with Republic Capital Access to talk with us a little bit about how to secure capital for government contracts and kind of explain different financing options. So, Matt, welcome. Thank you so much for being with us this evening.
Thanks for having me. Good evening, everybody.
Now, I want you guys to know, drop your questions in the chat. You know, I am not a financier, so ask them while you have them, right? So I want to start off a little bit, just sort of with the basics. It's no secret that government contractors, whether you're new or whether you've been at this a while, the financing topic does not necessarily discriminate. So just wanted to kind of have you here and provide a little bit of clarity on some of the different options that are out there and how these guys can overcome these cash flow challenges in their government contracting.
Sure. Well, as a bit of background, we've been doing this for Public Capital Access since 2009. I've been doing this for a decade now. Since our inception, our company's funded about 1,200 contractors and 4,000 contracts. So we have a lot of experience in the cash flow challenges of government contracting. You get more cash flow issues in government contracting than most businesses, in my opinion, primarily because of the you can have an exponential growth. You can go from $0 in revenue and have to deliver a $100,000 product, or you can have $1 million in annual revenue and quintuple your revenue with one contract win. So the nature of that, comes to cash flow challenges, and at its root, what we try to educate younger business owners on is cash flow challenges is a timing issue. So the cash flow challenges are solved by drawing a line on a piece of paper. And there's two big lines in financing. The first line is, did work start on a contract? That's the first thing. And everything before that line we call equity, and we don't do that. And no one does. You got to figure that one out.
Yeah.
And once you start work on a contract, you are into a possible working capital solution. And we would define that as you need capital 90 days or less to turn into a receivable, something like that. And that's probably generous for most government contractors. The next big bright line in financing is when you generate a receivable to your customer that's acceptable. And so the time between contract starts and that receivable generation is the hardest part. So if we look at a timeline and we draw out a piece of paper, we have a big line in the middle for invoice. And if I'm looking at it, everything to my left is pre-receivable, everything to my right is post-receivable. In the world of finance, everything to the right or post-receivable is relatively simple to fund, depending if you run into the right partners. And everything pre-receivable is tougher. And it's tougher because it's simply riskier. You haven't done it yet. So let's gauge what's out there that's tough. So we'll just go down three simple businesses we see in government contracting all the time. Services. So services pre-invoice financing, we call that payroll financing. That's actually pretty easy. We'll do that on our balance sheet. So if you're in a services space, that's the conundrum you face. I need to pay people before I have a receivable. The next piece is the product folks. I have to pay someone before I have a receivable to get the product to ship. That has a bunch of different flavors, but we'll just call that the product space, or we call that PO financing, which we don't do. We work with folks that have been doing it for decades. And then the third is kind of the manufacturers. We see that more with mature companies, and their pre-receivable financing is called production order financing. I need to buy some widgets and trinkets to make a whoosy much, we'll call it. And if companies have a good handle on the pre-receivable side, then they can kind of enter the conversations in the finance space and start kind of articulating themselves in a way that we don't have to provide that education. So in order to overcome kind of those cash flow issues, we always tell folks, like, do you need money pre-receivable, or you just need a receivables financing solution? And that could be at a bank. That could be at a firm like ours that provides receivable funding to government contractors. There's a lot of things that could be. How to solve that problem, what I firmly believe, is for a government contractor, your working capital, the solution that you bring into your company to provide capital, I equate it to a buoy on the water. If you have a lot of work and you have a lot of receivables, then your buoy goes very high. And that would be a revolving solution tied to receivables. What we, from a balance sheet standpoint, so if you all dust off your finance hats and I really, and Natasha, firmly believe that every government contract needs to have a really good understanding of finance because they're personally guaranteeing the whole thing. So you got to learn it. It stinks. Nomenclature is awful, but it's third grade math.
Yes.
So if you have current assets, use a current liability financing instrument to provide your liquidity. What we don't like to see folks do is get a term loan, which is that anchor. It doesn't change no matter what. And that's a long-term liability against a current asset. And that's a mismatch in our financial instruments. Now, if you're going to buy a tractor, you should get a term loan. But for most government contractors, you want to have some sort of flexible working capital solution where you only have capital outlaid with a pretty high propensity of it coming back.
Okay, so let's break that down a little bit because the terminology here is important, right?
Mm-hmm.
Most of our audience is aware of line of credit, right? So is that comparable to the suggestion?
So line of credit is, so in the finance space, we're really good at coming up with words, and a lot of words that kind of mean the same thing. So like a really,
so are we in government contracting?
Right? It's perfectly. So there's annual percentage rate. We all know what that means.
Yep.
So let's say annual percentage rate of 1, just for this example. Then there's another term called basis points. So you could say 100 basis points. That also equals 1% annual percentage rate. Or you could say 100 bips. 100 bips also equals 100 basis points, which also equals 1% annual percentage rate. So we have a lot of words that mean the same thing. Generally speaking, kind of roughly, a bank line of credit, a factoring facility, an ABL facility for a government contractor, not a manufacturing one, but just like a services one, primarily going to be based upon accounts receivable because that's your primary form of payback. And so if you're going to get a line of credit at a bank or a receivables facility from us or someone like us, it's going to be based on your AR. That's going to be the biggest delineation as far as how much you can get at any given time.
And you can pull that from your QuickBooks, folks. Your
whatever
AR,
and while you're in those QuickBooks, click the button accrual.
Yes.
Please.
Money
accrual.
I hope you're doing journal entries, but accrual based on what you've earned to date, not just
the bills that you've accrued to date but may not have paid.
Amen. Yep.
Yes, very good advice. So as far as types of financing options, because we totally understand the challenges. Even a lot of pretty experienced companies, like we were talking about, a little bit before we went live, these issues don't discriminate if you're new, if you've been at this a while. Anything can happen, right? Somebody at the government can be out for 2 weeks and, just maybe didn't hit the buttons, the approval button. So what are some sort of real world instances where contractors have had to hurry up and find funding fast, and like what should be? Because I know there are certain circumstances where this funding will be more accessible than this funding, but let's say they don't have great personal credit that they can really depend on, and their business is new, but they've won this contract and now they need to fulfill it, but they're way behind the curve. They're being more reactive than proactive. What should they do?
Sure. So a couple of things. So if you have receivables out there and you don't have a way to finance those billed receivables, either by using a bank line or a receivables financing entity, then you should do that because it's the lowest risk, least expensive form of financing. And if you're talking about building a capital stack for your company, the first step is, can I finance a billed receivable? And if that suffices the problem, then you're done. And if you're still short, that's step one. So you need to always have that and start looking at that. The second thing is you should go to a bank first. Like if you have personal collateral, credit score, like walk into a bank or use a fellow, government contractor, introduce you to their banker. Generally, what I tell folks is if one bank says they can't do the deal or provide you a credit facility, that's probably a you problem, not a bank problem. It's not because you didn't tell your story the right way. It's because they're all regulated. All banks' credit boxes are generally shaped the same type of square. I mean, there's a little bit smidge here and there, but they're generally the same. And so, that's fine. Most folks starting out of the gate are not ready for a bank facility for a variety of reasons. In that instance, if you're working with a really good banker and your banker is financing your SDVOSB buddy's company, ask him for a referral, the banker, for a referral to someone that can provide assistance. And that does two things. One is, in the non-bank space, welcome to the wild, wild west. I've seen it all. And I'll see something tomorrow that I didn't know today about something that someone did. So get a referral from a trusted source. And number two, you're evaluating that banker for your future needs. If they can't provide you an ulterior source to provide funding for your company that would make you be profitable or do well to come back to them and give you a traditional line, that's probably not a very good banker and probably not someone you want to work with. The bankers are wonderful. They're the politicians of they know everybody, and it's great. But they should be able to introduce you to, hey, this is a source to go to, or my CPA may know a source, or whatever it may be, and work that way. But I would start with the bank, because at the minimum, you're going to need a treasury services for your company, and we don't do that. No non-bank lender does. So you're going to need to have an operating account at a bank. So you should start there.
And that's great. Thank you so much for that. And we were kind of tossing around on banks, for example. Natasha, you brought up a very good point in the green room about, the difference between your large banking institution and your, oh my gosh, credit union. It literally just slipped my mind, completely slipped my mind.
Well, I think it's just, credit unions, and again, everybody is different, right? You could have a really great large bank and have a really good relationship with your account manager, but I got lost in the Bank of America spiel. So I had to find, and this is just where I was with Bank of America, I want to say like 6 years, and nothing against them because they were great, but I just needed like more of a personalized approach. As I'm growing, I need a little hand holding. And that's just something I need. And so with credit union, I was able to get that hand holding. I'm able to, they're very old school. Like, they're come in, let's have conversations, let's drink coffee, let's talk about what your goals are. And I need a little bit of that so that I can plan for my future. And they were able to give me a revolving loan, which I only pay interest on what I use. So if I need to make payroll, I can borrow from that until I receive. Until I don't need it anymore. Now I just use it for R&D or, research and stuff like that. But other than that, I thought that was great. So I think it really matters about your business, but also about the treatment that you get from your bank, because
what your needs are. Yeah. Be realistic
like
about
what Matt said, pretty much, if you feel
it's
like they're not helping you.
Yeah. I always think it's important, there's wonderful government contracting bankers at a lot of banks. And banks are just run by humans too.
Yeah.
And everyone has time demands. And unfortunately, it's kind of sometimes a math game, right? Like, obviously, if we're all running $1 billion company, whoever's financing us is going to give us a lot of attention because that's a really important account. And if we're not as big, maybe not, but it's still, there's humans involved and there's turnover. I think, like, for a government contractor, if you're going to really be in this business, the biggest evaluation criteria is, do you have to explain the FAR to your banker? Like, do you know what the FAR is? Yes, it's the Federal Acquisition Regulation. Okay, we can have conversations because I'm going to ask you for letters of financial capability when I go after SOUP 6 or CIOs before, or whatever it is, right? And I have to describe to you the acronym, soup salad at GovCon. So you got to balance that. And there's good government contracting bankers at community banks, at least where we are in the Mid-Atlantic. And probably there's in credit unions and folks I don't even know of near, bases. There's typically near bases, there's, a couple folks that know what's going on. Yeah.
There's a couple.
So, but I think you want to work with someone that understands your business, and the best place to start is if you're trying to get into government contracting, you probably know someone that's in government contracting, and ask them for a referral to their banker.
Yeah.
And that's a good place to start. Probably not walking in the branch.
I recommend doing that for CPA too. Just saying. I gotta say, I've been through like 4 of them, and you guys are not all created equal. So kudos. You are not all created equal. On that, I mean, and that's great because not only can whoever vouch for the banker, but relationships matter. Actually, on that note, my first YouTube video ever when I first started the channel, it started off with relationships over solicitations, and I see your backdrop is very similar. I appreciate that.
It is the motto of we're owned by a large family office in Arkansas called Stevens, STPHENS. No one's really heard of it unless you're in the Southeast. But their motto is relationships over transactions.
I love it.
And, at the end of the day, it's just a business deal. And, but it's about the people that are involved. And, for us, a lot of the times, we're providing funding and it's regimented in a predictable manner, but, the funding we're doing is to make a payroll.
Right.
The funding we're doing is to make sure a supplier gets paid, and there's a good likelihood that a supplier getting paid is probably a small business. So, you have to remember the cog, at least that we're in the ecosystem, is, we're trying to make people, sleep more and worry less.
Before we get into, because I definitely want to ask about some real world scenarios, but before we get into that, I definitely would love you to touch on, if you can, things that these folks should look out for when trying to secure capital, because it's no secret, the moment you register in SAM, you just have this giant target on your back and everyone's trying to jam their hand in.
It is unbelievable. Like, it's remarkable. Like,
yep.
So I think when you're securing capital, again, I'm not very smart. Just keep it simple. Did the banker that opened your operating account know GovCon? Ask them for a referral, like step one, right? Or find someone like yourselves, like, who do you know for this? That cuts out so many of the folks that we probably don't want to run into on purpose.
Right. Don't do a Google search is what that means, guys.
It's a really bad place to
stay
start.
away from Google if you're looking.
We'll tell people like if you're looking for financing on the internet, like it has gone badly.
Definitely.
But there's folks out there in the non-bank space that are brokers that are just taking a fee for booking a deal. I've run into a few that are very good. I've run into a lot that are not. Again, that didn't come from a bank. You probably didn't get that referral from a banker or your CPA or go into a convention or whatever it is. But like, as far as like the pitfalls, I look at more of the pitfalls as like, what are the things that will put you out of business tomorrow? It's when you mismatch your financial instruments. You get like a long-term liability against current assets, because if your revenue goes down, you still have to pay back the term loan. And then if you grow, you can't get more capital. So I think that can be risky for folks. Folks that don't understand your market. We onboarded a guy a couple of years ago. He's a reseller, and he was selling product to a very large buyer that's a prime on a large government program. And the finance company said, we don't know them, and set a very, very low credit limit to where he couldn't run his business. But he had a termination fee that was sizable.
Oh,
so he ended up getting out, got him out. He ended up getting the fee waived because they couldn't meet his needs, and he ended up had a great year last year.
That's awesome.
Work with people that understand your space. In the non-bank space, it's very common for a finance company to have what was called dominion of funds, which means the finance company gets paid first. We believe at Republic, there's actually a step for this in the FAR clause 32.8 called the assignment of claims. We do it every time there's a prime contract. We believe strongly in following the FAR. Some people think that out there. There's probably people that don't. But
Can we get into
Yeah.
that a little further? I want to. So let's talk about that for a moment, because
Mhm.
assignment of claims is not necessarily something that a lot of people are aware of.
Yes.
Mhm.
So we know the FAR clause, but tell me sort of what that means in the financial world, or
So
tell them
the
what that means.
inception of the assignment of claims, it's a 2-page document. It started in 1940s in World War II as an enticement to get banks to fund government contractors to develop, as fund companies. They were producing product for World War II. Obviously, it's a huge ramp up for the country. So it's a 2-page document. It hasn't changed since the 40s, but it means that on a contract, the finance company or banks can do it too. You can also do it in an escrow account. It just means that that entity gets paid first. So instead of the money going to the company's bank account, it goes to the escrow account or finance company or bank's control account. It could be either of those three. And then they parse out whatever dollar amounts they've owed less fees and remit the rest back to the company. So it means they just get paid first. It's a way of kind of securing the payment stream, if you will.
So, and that document has to, or that form rather, must be
Mhm.
submitted with the proposal. So,
Not with the proposal. It can be
not with the
done.
proposal?
Nope, that'd be done. It can be done at any time during the life of a contract. So we have done that on the first month of a contract, in the middle of a contract, near the end of a contract. It can be presented at any time.
So a contractor could hypothetically have an oh shit moment and need to reach out to someone like yourself and be like, okay, here's the deal. And that could happen after the award.
Likely it does. Like more often than not, we're brought in the middle of a work period on a contract.
Okay.
So someone's at a bank. Obviously, banks have various things they look for, and approving credits. That's probably 6 episodes worth. But they don't qualify. The bank wants to exit the facility, and then will do an assignment of claims on the contracts that the company needs finance in order to continue to meet their obligations. So it's very common that happens midstream.
Yeah.
It's probably atypical that it happens at the inception.
Okay, that's
I
good.
actually asked a contracting officer about this one time. And I said, hey, I got a really weird question, and you probably will never hear it again. But I have it because I get this question like once every 4 months. I was like,
No kidding.
what's the perception of assignment of claims from a contracting officer's perspective? Because it has to go to the contracting officers.
Good question.
And he's like, oh, I love when I see assignments of claims. And I'm like, please tell me more. I was not expecting that.
Yeah, tell me more. I'm curious.
And he's like, well, I was working with small businesses and I want them to execute on a contract. And if you're doing an assignment of claims for the purposes of financing, you probably have financing. You probably have money to make your payroll. It's one less thing I have to worry about.
Yep.
He's like, so I know that you're good.
I love
That's a gem right there.
Well, and his point is, and I think a lot of small businesses need to understand, is that your buyer, you're a business that your buyer's taking risk in is just as much as you would be taking risk in something else.
Yeah.
Like, are you going to be able to deliver on the solution to my customer or the mission?
Right. Right.
And so if you can't, that's on them. Obviously, that's why there's T for C and T for D clauses. So yeah, so it's a deal. So we believe at Republic strongly that you should always follow the FAR and live in fear of the tribunal. And if the FAR says you should deliver a blue paper cup on Tuesday, then that's a really good idea. You should probably do that.
Absolutely. Now, I know we already have like one leg into this question as it is, but to end on a good note instead of a scary note, what are some examples, like some real world instances that you've experienced along the way where, maybe there was one of those oh crap moments and, it had a happy ending, essentially?
They all have generally good endings. I have a number of examples. So I'll give the best example. So, and this will go from soup to nuts. So we had a client, nice little line, about $500,000. And we gave them a letter. We do letters of financial capability. So what you're talking about on the pre-proposal, Ashley, is to suffice FAR 9.104, which is, does the contractor have the financing resources available to execute on this particular contract. I think I've done this week probably $50 million worth of letters.
Wow.
Soup 6 is in the air. We'll just say that.
Yes. Oh.
So we're just cranking out letters left and right. So we gave this contractor, the client, a letter for $20 million. It was a huge game-changing proposal. They win it. And of course, it gets protested for like 9 months. We had to present a letter every protest because a lot of the protests is around could they execute. Well, they won the contract. They went from about $500,000 a month in revenue to 8 to 10 million, depending on the month.
Wow.
And they just sold for over 9 figures in the spring of 24.
Wow. Yeah. Round of applause.
One contract. Now, I mean, we got to be along for the ride, and they're awesome guys. There's a lot of takeaways from that story. That one is they never ever worried about the cost of their funding. All these guys cared about was margin and execution. That's it. They could get, our costs we're a little more than a bank, but we're not credit cards. I mean, we're low teens.
Right.
Actually, then we're probably a smidge cheaper. But they all they cared about, were you there to make a payroll? Are we executing? Stick it in a file drawer and let's go run the heck out of this company. And that's what they did. So number 2 is like they were planning way around the curve. So we knew about the contractor going after. They're like, we may need support. It may have these components. And we're like, we would solution this way, this way. We give you this and we give you that. So they had all their tools in their toolbox. They knew what the problem was. And then we knew that on this payroll would be the biggest issue. So they were going to need a earned unbilled facility to make a payroll before there was a receivable.
Wow.
So, that's a good example. And that's very clean. It's a very clean one.
Yeah.
So kind of a messy example. So we ran into a company, it was about this time last year, and they got hooked on the merchant cash advance loans on Google.
Oh yeah.
With a broker. And so at the time we met them, a couple $100,000 a month. So like we'll just say 300. But they had merchant cash advance loans on their balance sheet of like several, like $700,000-800,000.
Wow.
But they were winning work, and so as they were kind of ramping up, that's where we got introduced. And so we said, well, there's a couple things here, and this is kind of where I think differentiate ourselves. We're really big believers of we're going to kind of probably tell you what you need to hear, not what you want to hear.
Mm-hmm.
So we said, listen, like you got $700,000 of bad debt. And we don't do term loans, and I could get into why we don't do them, but basically like it's a conflict on our balance sheet. And it should be, that's why like in the non-bank space, you got people who do revolvers and people who do term loans. So we're going to bring in a term provider and they're going to give you 500 and you need to come up with 200 of equity. And here's why. There's no scenario, we told them, in which the math works that you can pay this back. So let's just call a spade a spade. You can't afford to pay back any more than $500,000 in the next couple of years. So you're going to need to find 200K of equity. And if we're not the right solution for you, that's cool. But we would be bringing a solution to you that mathematically you would not be able to perform on. And that's not cool. So
Right.
You need to bring in 200. Okay. We're going to bring in billed and unbilled AR. So we'll help you with the payroll and the receivables and start steady state, get the cash flow more predictable so you can get money in. And they had a joint venture. Joint venture won a large contract. And so this is how we're going to do that. So we brought in the term lender. They gave him $500,000. The owner put in 200 of equity. We brought in billed and unbilled. And so when we met him, he was billing about $500,000 a month, $300 to $500 a month in billings. And I think in December, it was a little over $2 million per month.
That's incredible.
Now, if we didn't meet him, I don't know what would have happened, but he was probably at any point during that process, days to a couple weeks away from going out of business.
Oh, wow.
Because, the rate of those MCA loans are really high. And he had long-term liabilities against current assets, which is a mismatch. So like as he was growing, like my clients, if they call me and say, hey, Matt, I just went into a contract. I'm going from 30 to 60 people. I'm like, so you need to double your facility? They're like, yeah. I'm like, oh, cool. We'll get you the amendment this morning. Have a great day. Pop the champagne. So we just raise it. But if you're in a term facility, like that's not how that works.
Right.
So that's a kind of a good case study of like, you need to plan well, but also be super mindful of having the right financial instrument in your company.
Mm-hmm.
Last story, because those are two services, we'll do a product company just to keep everybody happy.
Mm-hmm.
On the product side, this is a small caveat, personal pet peeve. You will do as much work on a $30,000 order as you do a $300,000 order. And I've never been on the BD side of a government contractor. But like, it's just a couple things about the product space. Small one-off orders are daggone hard to fund. Like no one really makes any money. So like if you need $11,000 to deliver something to the government, like that's a HELOC, that's Amex, that's probably not a finance company.
Right.
Like it's just a lot of money there. So in the product space, like the people that we see that are really successful, they go from like $0 to they'll go from 0 to like 5 million in a year. And they have one of two components almost always. They know the buyer really well. So you got that. And then they find the thing that the buyer wants to buy and they figure that out. Right? There's one other thing that they have though. They may not know the buyer, they know the supplier.
Okay.
And the supplier gives them vendor terms. So then they got the product and then they figure out who buys that at the government. So they either know who's going to buy it and they go find the supplier, figure that one out, or they got the product, they get favorable terms because they got the product and they go find the buyer. But what we have not yet seen is someone that doesn't know a buyer and doesn't know a supplier and is successful. I haven't seen that one yet. But I've seen both of the others.
Sadly, there are a lot of those.
And so we'll get a lot of calls from folks in the product space and they're like, oh, and you're like, do you know your supplier? No. You know your buyer? Well, I'm going to bid after this, bid after that. That's super hard to be successful.
Or I called a bunch of suppliers and they won't talk to me.
Yeah.
I wonder why.
I don't even want to do anything. I just want you to do it all. I don't want to talk to the supplier or the buyer.
You got to get on the phone. You got to find these people out. So supplier story. We had a couple of guys, they got together, they got a company. They call me up. They're like, we're referred by someone to you guys. And I'm like, cool, startup, SDVOSB. And I'm like, all right, so what are you guys going to do? They're like, we're going to sell stuff to the VA. We used to work there. Like, we know what they buy. I was like, okay, sounds good. I was like, so what size do you need to start? And this is always like the good gating question in product companies. Like, what size of facility do you think you need? Because we have a minimum term, just like, Natasha, your business. Like, hey, wrap below this. We ain't getting out of bed this morning.
Correct.
Like, if the wrap ain't there, go down the road, right?
Yep.
So these guys go, we'd like to start at $500,000. I'm like, all right, let's go. So we'll see what these guys do, right? So their first year, they probably did $7 or $8 million. And so somehow they figured out how to resell vehicles to the government.
That's amazing.
And so we hooked them up with purchase order financing through a good friend of ours. And this guy puts up letters of credit, which is a letter of credit in the PO space is by far the most secure way to do a transaction. Because if you kind of think about it, like, I don't want to give cash to a supplier because then, they may run off with my cash and not actually give me my product, which would be bad. So a letter of credit, the cash is only given to the supplier when they've delivered the stuff or shipped the stuff that they said they're going to do, which is kind of a better way to do it. So they put up a letter of credit on their behalf and to a couple of dealerships. Dealership ships the cars, they invoice, and they do like 6 to 8 of those transactions a year, and they just kill it.
That's great.
Just kill it. So
I mean, that's not a terrible gig to have, but they spent the time building the relationships they needed to work out and negotiate those terms.
And they knew how the government buys. Well, not even that. They found a dealership that would take a letter of credit.
Yes.
And this is where, like, if you understand, so they didn't know finance before, but finance is easy. It's third grade math. And they understood oh, if I get a letter of credit, what does that do? Oh, that means they guaranteed they get paid. Okay. So they probably got on the phone to like a bunch of dealerships and he goes, if I present you a letter of credit for $500,000, it guarantees, it says that when you do these things, you're going to get a wire from, because typically a letter of credit is backed by a bank, like a large international bank.
Right.
Then you're going to get this wire. Someone there is going to understand that.
Yeah.
And go, this is a pretty safe transaction.
Done.
And all of a sudden, you're good. But they knew how to articulate it. And they kind of listened. And they took it and they go, oh, this is a flathead screwdriver. I can make this do this. Right. And then they got their supplier. And then they went and got their buyer. So they kind of put it all together. But, we've doing this for a while. We have lots of, success stories. I think that the biggest takeaway that I tell folks that are getting into government contracting is it's different. You're going to grow fast. It is kind of hard to get capital. And I think what gives people anxiety is it's the one service area where you can't sign someone up. You have to qualify for it.
Right. That's a good point.
And so if I don't qualify for it, how do I get it? And there's a lot of ways to get it done. That's why we exist in that gap where banks can't provide capital and other folks exist. But it does take some time. You have to research. You have to talk to people. You have to get referrals and kind of work your way kind of through it. No different than you would selling your product to the government.
Well said.
Makes sense. Very, very excellent advice. There were a lot of gems dropped today.
Yeah.
You guys were listening. So if anyone has any questions, please, I don't see anything in the chat. You guys are super quiet tonight. Those of you who are watching us live, it is your last chance if you have any questions for Matt. I gotta say, I hope that you guys are warmer than I am because it's freezing here in Florida. We have about 8 inches of snow in Pensacola. And
seriously, they get that much in Pensacola?
Oh, yeah.
Bro, it's been 47 years since it snowed in Florida. Nope. We're all like,
everybody's losing their minds.
I heard in Charleston someone got 9 inches I talked to this week. We're up in Northern Virginia. It's been like 15 degrees, but we got 2 inches of snow, so it's just frozen ice now.
Yeah, the driving conditions.
I was like, it looks like snow, and this is Tampa. What in the world? I've never seen this. People are videotaping like snow on the sand.
There were videos of people going to the beach, and instead of footprints in the sand, it was definitely the snow. We don't know what to do down here.
Well, in the north, there's salt trucks that are like designed to spread salt on roads. So I saw a video of 2 guys in Pensacola. I think it was Pensacola. They're riding on the back of a pickup, like on the tailgate, and they had a Solo cup, just waving it around to spread the salt.
We call that hashtag Florida man.
But I get it. You don't have the equipment, right?
No, I mean.
There were
like let's go drop $250,000 on a salt truck.
I'm pretty sure they're contracting that out. They have to.
They have to.
We don't have that kind of equipment.
We don't. And it was just funny because I sat there and I was like, I don't have a coat.
I don't have a coat either. I took them all up to Pittsburgh. But that actually reminded me of a lowest price technically acceptable contract. My buddy driving down the road with the salt cup hanging.
We need some salt. Yeah.
That was a quick one.
Red Solo cup. Yeah. Well,
well, I don't see any comments from the viewers this evening. They might come later on the on demand, and if they do, I'll be sure to reach out. But I really want to thank you so much for being here.
Yeah,
that was incredible information and just really gave perspective in a lot of different areas that I'm sure these folks had questions about. So thank you, Matt, for your time and just for what you guys are doing for the government industrial base. Very appreciated.
Well, you got it. Thanks for all you all do, and thanks for having me.
Oh, yeah.
Thank you. And to our audience, please be sure if you're new here, subscribe, tap the bell for notifications. We're here most Thursdays live at 7. And if we're not, it's probably a holiday. We will be, both of us will be at 8A, National Small Business Conference in New Orleans, February 11th through 13th. So if you're in our audience and you're going to be there, please be sure to come by and say hi at booth. What booth?
24.
Oh, you must be in the front row.
My
All right.
colleague Steve Coppinger will be there, so we'll post.
Oh, will
something
he?
Yeah, we'll post something on our social media, on our LinkedIn page, I guess,
Nice.
about him going down there. But he'll be down there.
I'll be sure to seek him out and say hi.
I'll introduce you guys via email. So
I would love
Excellent. Yes, I'd love that. Well, thank you, everyone. You have a great rest of your week and weekend. We'll see you back here, same time, same place next week.
that.
Bye-bye.
Bye.
Thank
Stay
you.
warm.